Hello everyone, welcome back to Fundrise Finance. Though in the last 1 week, the market is down 0.3%, we have seen such a huge fluctuations that on one day, when the Fed announced the 0.5% rate hike, the market zoomed up almost 3%, but right the next day, we saw the market falling more than 4% on Thursday, and it continued to fall more and more as it went into Friday. In short, we're in such a volatile market that sometimes no amount of good news is enough for the market to go up, and in some cases, the market zooms up even if there is no such good news. Year to date, the S&P 500 is firmly in a correction territory, down more than 14%, and the Nasdaq much worse in a bear market territory, down more than 23%. And to add to that, the Dow Jones Industrial Average is also in a correction territory, down more than 10% year to date. Dow Jones, which is a collection of all those big, large cap boomer generation stocks, which are always thought to be a safe house for any such volatility, even there we don't have any respite. In my opinion, one good way to play this volatility is via the covered call ETFs like QYLD, which has a Nasdaq 100 as its benchmark. When we compare QYLD to its Nasdaq 100 regular ETF, the QQQ, here we see year to date, the QQQ is down more than 23%, whereas QYLD is down just over 14%. On top of that, the QYLD ETF gives a juicy dividends of more than 11%. In fact, QYLD is yielding currently just below 13%. Similarly, when we consider XYLD, which is the S&P 500 covered call ETF, and compare that with S&P 500, we can see that S&P 500 is down more than 14% year to date, whereas XYLD is down just over 8%. On top of that, XYLD currently yields more than 10.5%. Likewise, we have RYLD, which is the Russell 2000 covered call ETF, which is down 10.6% year to date. But when you compare that with the Russell 2000 index, it's down more than 19%. On top of that, RYLD currently yields 13.6%. These hard call ETFs usually tend to do much better in a volatile market or when the market is more going sideways, because that is when your underlying asset is not actually appreciating much, but at the same time, the investor is earning from the dividends from these ETFs. One other very highly regarded covered call ETF is the JP Morgan Equity Premium Income ETF, JEPI, which has the S&P 500 as the index. And year to date, the JEPI ETF is down more than 8%, but when compared to its own index, has done much better than the S&P 500, which is down more than 14%. Also, JP has a nice good dividend, more than 8.2%. JP, since it launched in middle of 2020, has been widely well received because of its low expense ratio of just 0.35% when compared to all other covered call ETFs from Global X, which are the QYLD, XYLD, and RYLD. They all are having the expense ratios around 0.6%. So right out of the gate, you have an advantage of 0.25% when you go with JP compared to its counterpart, which is the XYLD. You can see that it has an assets of more than $4 billion in just over 2 years of its existence, which is really, really good. Looking at this, JP Morgan has started a new ETF based on the Nasdaq 100, which is the JEPQ, that is the JP Morgan Nasdaq Equity Premium Income ETF. This ETF just started earlier this week on May 4th. So there's not much history at all for this ETF. So just since May 4th till May 6th, when the week ended, we can see that this ETF dropped more than 2%. And when I use the same timeline for QYLD, I can see that in the same 3 days, QYLD has dropped minus 2.15%. And compared to its benchmark, which is the Nasdaq 100, we can see that QQQ has dropped almost 2.5%. So in its very short existence of just 3 days, we can see JEPQ actually doing better than QRLD and QQQ. So let's go a little bit detail in what this ETF is and what it does. Designed to provide current income while maintaining prospects for capital appreciation is really good. So it not only focuses on giving income, but also enough opportunities for capital appreciation, which is what its elder sibling JP does. Generates income through a combination of selling options and investing in US large cap growth stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends, seeks to deliver a significant portion of the returns associated with the Nasdaq 100 index with less volatility, constructs a long equity portfolio through a proprietary data science driven investment approach designed to drive portfolio allocations while maximizing risk adjusted expected returns. When we just give a quick look at JEPI details, we can see it having a similar setup, seeking consistent premium income with lower volatility. When you look at the top 10 holdings, you can see Apple having almost 10% allocation, Microsoft almost 9%, Google 6.5%, Amazon almost 5%. Then we have this ELNs, which is almost, I would say, around 17%. Then we have Tesla, which is 3.5%, and Facebook at 3%. So more than 50% of the portfolio is just into these top 10 holdings. Going by the details from JP Morgan, we see that both JP and JEPQ share the same ex-dividend date and the payment dates. So for the month of May, anyways, JEPQ will not be considered because it launched just on the 4th of the month. So next month, in the month of June, 1st of June will be your ex-dividend date, and the pay date would be June 6th. I'm assuming JEPQ should be having slightly higher yield than JP, given it is based off the Nasdaq 100, which is much more volatile compared to your S&P 500 based ETF that is a JP. Now, would I add it to my portfolio right away? I think I will wait it out for a month or so because I'm currently in my portfolio, I already have SCHD, which is my core holding. So GP and DEVO along with SCHD make up 70% of my dividend pie. I also have 10% contributions into QYLD, XYLD, and RYLD. So I already have those covered call ETFs in my place. So I don't want to really swap out QYLD for JEPQ right away. I would like to see how JEPQ is performing, how much is it yielding, and then make a choice. If JEPQ is performing much better than QYLD, then surely I would swap it out because, like I said earlier, QYLD has an expense of 0.6% and JEPQ has just 0.35%. So it's 0.25% benefit right out of the gate. So why should I just leave it out there? So that's my quick take on JEPQ. I feel JP Morgan really did good in bringing this product out. And if it performs as good as what JP has done in the last 2 years, then JEPQ should also be a good winner. And this volatility is surely to continue for some time now. And covered call ETFs, like I said earlier in the video, should give a good opportunity to not only ride out this volatility, but also at the same time gain some returns in the form of dividends. Hope you like this video. I would really appreciate if you could hit that like and subscribe buttons and also provide your opinions on JEPQ ETF in the comment section. Do you have covered call ETFs in your portfolio? Let's discuss more. And until we meet in our next video, let's try as much as possible to be financially healthy. See you. Bye.